We're watching markets carefully.
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
A massive pain trade. We've basically had almost no fund inflows this year.
Markets are going to really struggle over the next couple of months.
We see a lot of people embracing that short duration fixed income trade.
The credit markets can really withstand a lot of that elevated yield.
I just want to be cautious. I don't want to buy into something that turns into a bubble.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Before the Super Bowl, we are here with you on a most interesting Friday, staggering to Tuesday, and an inflation report. I hope I nailed that right.
Well
interesting
done.
hour. We're going to talk inflation here. Got a lot of other things to talk about. Steve Paglia going to join us as well, owner of the Boston Celtics. We'll go all sport, 8:31. Set your watch. Farrow on Liverpool.
Looking forward to that, 8:31. And then if he doesn't answer the question, I'm leaving.
You can stand up and walk out.
I'm just going to walk out. Let's talk about CPI on Tuesday. We've got some estimates for you. Here's the survey. The median estimate so far, month over month, 0.5. That's a pickup. Strip out food and energy month over month, 0.3. That's in line on core. You want some year over year figures, Tom? Still holding on to a 6 handle, 6.2, the estimate there. And for core, we're looking for 5.4. Those numbers drop Tuesday morning. Important data, and of course, back and forth right now. You know, the equity market's a little bit soft. The VIX out of solid stick, 21.93. Make that at 22. Some yield dynamics. John's mentioned oil, Brent, $86 a barrel. But what we're going to do quietly, and this, folks, this is the unspoken into the weekend, and this goes back a few days ago when there were reports that people at Goldman Sachs maybe wanted to talk to the board. Our Sri Natarajan reports moments ago, and Bloomberg reports that Goldman Sachs's last key Marcus consumer banking hire, see ya, Mr. Nahar, John, is out the door. Wow.
He's on a retainer or whatever.
Are you suggesting that we should be thinking about the pressure building on the leader at Goldman Sachs?
Every firm is different. Every firm has different pressures. Deutsche Bank, look at the pressures right now in European banking.
On Credit Suisse,
and
sure.
Credit Suisse particularly, and I don't want to cast any aspersions to anyone here, but it is in the ether here as we go into later February.
Looking at the reporting from Sri, executives debate whether the unit can cut the 2023 loss to $1 billion.
Yeah.
That's a tough time for that unit.
It's a really tough time, and of course with those layoffs and bonus cuts as well. Let's get back to the markets here, John. What do you see in the bond market? And there's a number of steers. I see the German 2-year out to new highs.
Front and center yields up, both in Europe and the United States. We're back through 450 on a 2-year. Off the back of that, equities down. We can talk about the crude rally, close to 80 at 79.50, up by 1.8% off the back of Russia saying they're going to cut output by 500,000 barrels a day, and delegates from OPEC Plus suggesting to us here at Bloomberg they won't offset it. As we look ahead to the data next week, though, I want to pick up on this tweet from Connor Sen of Bloomberg Opinion. Lisa,
Please.
you'll like this. The February jobs report is a bigger deal than next week's CPI report. What do you make of that take?
That goes to what Barbara Reinhardt was saying, that the year-over-year comps in CPI will suggest that this disinflation and will have a rapid shift downwards. You might even get a better-than-expected CPI print, but that doesn't signal the strength that will come into play in July when we start getting the June data. And that, I think, is really the key takeaway to what Connor Sen is pointing to. Look at the labor market data. It has a longer run rate of what we can expect.
Well, I think we've had a real triumph of a Friday. It was supposed to be a jumbo. It was going to be a clumsy Friday. And, you know, we don't need to spend the time on it now, but Bill Lee pushing against consensus on China.
He did,
You mentioned Reinhardt of Voya, the ING affiliate. Barbara Reinhardt was brilliant pushing against international consensus there. She's saying domestic. I mean,
Let's
there's
be
some
clear,
real
though,
calls here.
what she is saying, and to Lisa's point, is that by the time we get to July, we're going to start to have a big debate about how sticky this inflation story is. You can maybe surf the dreams, the hopes of the fumes left from the disinflationary story into summer. That might be the view of some of the bears out there. But what she suggested, Barbara suggested, is that once you get to July, and you mentioned it, that you'll look back at a June CPI report, which will, Lisa, indicate stickiness.
Well, and this is the reason why perhaps when you look at the labor market metrics that might have a longer run rate with respect to how to view this recovery, not to say what that's going to do for stocks, though, because stocks will respond in a knee-jerk fashion.
Well, they'll do what they want,
exactly.
right, based on the misses we've seen and the lack of punishment on those misses from earnings. Do you remember we started the year, it's all about earnings, it's all about earnings, and then it wasn't all about earnings.
Even the bears, though, are coming out and saying, well, you can start selling around 4,200. So they're even kind of pushing back and saying it could have longer
They were
legs.
even discussing 4,200 as a miracle versus
Well, it used to
10
be
weeks ago.
3,900 was the easy sell, and now it's 4,200.
4,064.
Well, I saw the same from B of A, and I don't want to pick on anyone. You know, it's not our style to do that. But when you hear people say there's 20% downside, there's 20% downside, they've said the same thing all year, except the market's 10% higher. You know, it's like it's difficult to take that call and actually do anything with it.
Well, critically, and this is for our global audience, folks, on radio and television, or global Wall Street audience, I should say, they're not going to, the bears aren't going to recalibrate, John, until they see that inflation report.
And that's the European equity call from B of A. Credit where it's due. We came into this year, Savita Subramanian said one thing, upside risk to equities. She really believed there was an upside risk to equities, and I think I catch up with her Monday morning. So looking forward to that conversation and just making sure that everything's okay.
John, quick data here. I'm going to look at Chinese yuan, John. I'm going to look at renminbi here, 6.81 yuan, a weaker renminbi this morning. What else do you see in the data?
A CPI, a bit elevated in China, Tom. We'll see if they can respond to that. But overall, the picture as follows. Equities down, TK, by about 0.6%. Right
now, we are briefed. It's been a really interesting morning of briefing here. Emily Rowland joins us, co-chief investment strategist at John Hancock Investment. Are you going to rewrite this weekend, Emily, or do you have to wait till Tuesday, 8:31 a.m. to do the rewrite?
I feel like I should have some good Valentine's Day puns ready for the inflation print on Tuesday. So come back to me on that one. But it is going to be really critical. And this week, it feels like there's been a big shift in the mood music, as you would say, Tom. And we've had higher bond yields. We've had oil prices rising. And most importantly, the dollar strengthening. You know, you think about these moves in currency, the dollar has been at the epicenter of every move in the markets. The weaker dollar trend that started in the fourth quarter really spurring this risk-on rally. And over the last week, that narrative has changed a bit here. So we think that that's going to be really critical to watch. Inflation is going to be huge on Tuesday in terms of the way it impacts bond yields from here.
You look at corporate earnings differently, but the basic idea here of corporate earnings and the resiliency forward, is it there?
By the way, I want to make a comment on what John just said about earnings. It is amazing that some of the huge earnings misses of some of the world's largest companies hasn't even been a big story over the last few weeks. This has been an entirely macro-driven market. So when we look at earnings underneath the hood, negative 5%, 70% of companies having now reported for the fourth quarter, it's okay. But some of the themes are really critical. You know, revenue growth was the major driver of earnings. It sort of saved the day for earnings in 2022. But now we're hearing more about margin pressure. We're hearing about companies dealing with that via layoffs. You know, buybacks are sort of back in the narrative. So, you know, we think this is going to be a tough environment for companies going forward. Costs are elevated, especially the cost of capital having risen a lot. That is yet to be absorbed. And top-line growth slowing meaningfully as consumers start to retrench. Companies have too much stuff. We think there's going to be a major war on margins in 2023.
So, Emily, what explains the rally year to date? And do you think we all run the risk of assigning some kind of fundamental narrative to a story that doesn't deserve one?
It's just so hard. It's not based on fundamentals. It's so hard to identify. And you all have been talking a lot about Europe this morning. It's like, you know, I think about it. Before, higher inflation seemed good for Europe because it was better for the euro and better for European businesses. Then we get this miss on German inflation, and that's good for Europe. You know, stocks are reacting positively either way. It's sort of this odd win-win situation that's hard to pin down. And there could be an element here of a technical rally, positioning changes. You know, investors realizing that they didn't own enough Europe, they're short covering, and now sentiment's taken hold, momentum's taken hold, and a lot of investors moving to that part of the market. You know, we haven't fully embraced that trade, admittedly. We've been overweight domestic equities like your previous guest, and that's the reason for that is because it's just a higher quality market, better earnings, more companies with great balance sheets, lots of cash on their balance sheets, a limited need to tap the capital markets in order to grow. That's where we want to be positioned in this environment.
Coming into 2023, Emily, a lot of people were saying this is going to be the year of active management. We've been hearing about that a lot. I'm wondering about the messaging around an active portfolio, about whether this is about avoiding losses or about whether this is delivering outsized gains, and what that tells us about where the sentiment on the risk-reward continuum really has shifted.
Yeah, to us, it's all about risk management in this environment. And it's amazing to see the kind of emergence of the risk on trade, whether it's, small cap equities, cyclical stocks in Europe, waking up in the morning and hearing the headlines around meme stocks rallying again. You got to think to yourself, oh my gosh, we're doing this again. So investors are really moving back in this direction of taking risk. And there's always a sort of celebration of the Fed pivot, or this idea that the inflation is receding and the Fed can kind of see the light at the end of the tunnel in order to pause. And that's really kind of emblematic of every cycle. You sort of see this play out again and again, where soft landing hopes get priced in and then ultimately they're dashed. And unfortunately, we think that is the narrative this time, is the lagged impact of central bank tightening globally is going to start to bite here. So we would be careful about reaching for the riskier corners or pockets of the market here, and we would be redeploying assets in higher quality, more defensive areas.
Interesting.
And
Emily,
bonds. We love bonds.
Have you got a Super Bowl pick for Sunday? I don't know what I'm doing.
Oh my gosh, I don't, but I have really good squares. So I'm excited. I got all the zeros and threes. Yeah, I'm psyched.
You know what she's
no
saying
twos,
there?
What does that mean?
no eights.
The brackets.
Emily, what you need to know is John Hancock has two skyscrapers. There's new John Hancock and old John Hancock.
Okay.
Everybody working in old John Hancock has no clue what they're talking about. And in new John Hancock's where all the young hip people like Emily are.
They know what they do.
And they do these betting pools where it's a sheet of paper,
okay,
and it's squares,
and you
bet, and they all vary a little bit, but it's like, where are we at the end of the first quarter? Where are we at the end of the game?
Right.
They're all vary a little bit, and you put up, a small amount of money. Emily's popping what, $1,000 per square?
It's probably.
I think she's.
I think someone in the office did that last year. I think I still owe them $10.
So how much was it?
It was $100 a square.
Oh my goodness!
Good, big time.
Congratulations.
It's for charity though. It's my son's youth. It's for youth football.
Nice compliance save, Emily.
Emily Ryland of John Hancock Investment Management. $100 a square over.
She bet on Tom Brady.
That's not going to work out this year.
Doing what?
Even I know that. Emily Rowland of John Hancock, thank you. From New York, futures lower. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. A surprise at the Bank of Japan. Bloomberg's learned the Prime Minister, Fumio Kishida, will nominate Kazuo Ueda to take over the central bank in April. That led to a jump in the yen. Here's a professor and a former BOJ board member. Ueda has expressed caution over raising interest rates prematurely. Reportedly, Deputy BOJ Governor Masayoshi Amamiya has refused to take the job. In Turkey, 3 survivors were pulled from the rubble today, more than 100 hours after they were trapped by the killer earthquakes. Rescuers had worked for more than 3 straight days. Meanwhile, the death toll in Turkey and Syria has now climbed to over 22,000. Russia has launched a number of cruise missile attacks on Ukraine today. Ukraine says the targets were critical infrastructure in several cities. Meanwhile, Germany's Chancellor Olaf Scholz has asked European leaders to deliver German-made tanks to Ukraine as promised. The goal is to have 80 of the Leopard 2 tanks there by the end of March. Russia is retaliating. Moscow plans to cut production next month by 500,000 barrels a day in response to price caps imposed by the West. That is equivalent to about 5% of January's output. The news sent crude oil prices higher. And shares of Lyft are plunging. The ride-hailing company says it will prioritize lower prices to attract even more customers. That's a move it expects to shrink future profits. Last month, Lyft cut base prices to keep up with a similar move by the larger rival, Uber. Global news powered by more than 2,700 journalists and analysts. I'm Leanne Gerrans. This is Bloomberg.
top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
The problem that you have in the bond market is that you still have the Fed acting somewhat aggressively. You know, even though they've had somewhat of a more data dependence, it seems to us as though they're convinced to raise rates at least 2 more times over the course of this year.
Barbara Reinhardt was fantastic this morning, the head of asset allocation at Voya Investment Management, essentially making her case, Tom. This is what she's advocating for. She thinks you get to July, you look back at a June CPI report, and we have a much bigger conversation, debate perhaps, about sticky inflation.
It's been the triumph of this Friday. Friday's about thinking into the weekend and thinking forward. That's why McKee's sitting next to me. And Reinhardt was adamant, pushing against the zeitgeist. Buy America is what she said.
McKee's going to explain how the UMich consumer sentiment data is put together. It's constructed. It's going to be great. Do you want to take it away, Mike? Do you want to tell us?
They call people up and ask them what they think.
Like 600, yeah, but seriously, like 600 people. They call up 600 people and just say, they go through a list of questions.
They go through the month, so you get some of it towards the end of a month when when some of the news has changed. I don't think we're going to see a big change in the Michigan numbers. Gasoline prices went up. They're heavily affected by gasoline prices in that survey. So we'll see what people's reaction to that is. But the inflation numbers probably won't move much because the inflation numbers had been coming down. Now, you want to ask about CPI next week, don't you?
Take it away.
That's going to be the problem. I got bad news on that score. We're going to see, according to the Bloomberg consensus, a fairly large increase in CPI on a month-over-month basis, 0.5% for the month of January after a 1/10 decline in December. The core is not going to change. 0.3 still gaining in the month of January. And on top of that, the Bureau of Labor Statistics is changing the weighting of the categories in the CPI. They used to do it every 10 years.
And now every year.
They moved it to every 2 years, and now they're doing it to every 1 year. So this will reflect last year's weightings. And overall, economists say this is great because it will more accurately reflect what we're buying. But it is going to probably push up the core rate. Omar Sharif says we could see the core rate 2 to 3 basis points higher just based on this statistical change rather than based on inflation.
Mike,
and the Fed's watching the month-over-month numbers.
Well, exactly. Should we stop looking at year-over-year with that in mind?
Yeah, I mean, Mr. and Mrs. America and Joe Biden are going to look at the year-over-year because it should go down because of base effects. But the month-over-month sequential change is what matters to the Fed.
So is a dozen roses here on Valentine's Day and overweight? Is that, Farrell, asking for a friend from England?
Have you looked at the prices?
John is.
He said $500 earlier here in New York.
Well, you're looking at the wrong place. I think that's a little bit high.
But
not that she doesn't deserve it, but that's a little bit high.
I want to dovetail this inflation. Nice say there, Mike. I want to dovetail in this Fed speak that you live every day with the Michigan study this morning. And I don't like the 5 to 10 expectations. I want to look at the 2028 to 2033 expectations. Why do we do that? We have no clue what the expectations are that far.
And the funny thing is, people have come down a little bit in their numbers that they give for what they think inflation is going to be, because I think inflation news has been so front and center. But for years, people in this survey were answering, oh, it's 7 or 8%, things like that. And you sort of had to extrapolate out from that what they really meant, because people had no idea what inflation is. The expectation here for the 1 year is it goes up 0.1 to 4%, but that is within sort of a margin of error for the Fed. They're looking for stability, not for a major drop.
They're looking for anchored, these words.
Yeah, anchored.
They'll be in the minutes. I'm reading the minutes this time around, just so you know.
Chairman Powell told you so.
Anchored, thank you. Anchored and stability. What does anchored mean, and are they becoming unanchored?
No, they've been pretty well anchored. Anchored means that they're not rising out of control. I mean, you could, if you're going the other way, have them falling a lot, but at this point, they're not rising so much, reflecting people's feeling that inflation is going to get embedded into the economy. And you don't want it embedded into the economy. It's a lot harder to get it out. So the fact that they're staying where they are, we're also seeing market expectations drop for inflation over the next year to 2 years, and that is good news for the Fed.
At least I can report that tuition CPI is anchored, as they say.
Is it?
They're putting a chain around men and women's legs.
They're anchoring them. They're anchoring their financial situation. Do I care, Mike, too much about used car prices and car prices in general? Because I've been tracking that so closely, and maybe that's just, you know,
well, you're more fun at parties than other people. But
why are you looking at me?
To know why the CPI is going up and down is a kind of a nerd thing, and a lot of people on Wall Street are going to look at that because they want to try to figure out why this is happening, and their bets are going one way or another. But the average American doesn't care. They care about the year over year.
Bramo right now at the party. People having nice conversations, a good time, a few drinks. Bramo rocks up. Let me tell you something. Pulls out the charts. They're not even talking about markets or inflation. I need to tell you about used car prices right now.
Well, used car prices have gone up a little bit in the most recent
everyone
month.
would be interested.
And inflation nerds are worried about this.
Well, that's my whole point, is that actually they were falling for a long time, or for a couple months, and people were saying, okay, this is the big disinflationary push. And now they're going back up because there isn't the same supply left over from the pandemic era and the lack thereof of, you know, people who are buying those fleets of cars. It matters, and it matters to people's lives if they want to buy a car.
It matters to the numbers, but here's the thing about inflation and the way we talk about it.
Great party.
The price of a used car is still going to be significantly lower than it was, but we talk about percentage changes. So it goes down to a level, goes up a little bit, and there's a percentage change that adds to inflation, but it's not really the kind of inflation we were seeing when prices were just going up and up and up.
Do you remember that scene where the monkeys would be in the boardroom and they'd have the chart and it was pointing in the wrong direction, so they'd turn it the other way and make it look better? And then they all started
That's
clapping.
what we like to do.
That's Lisa, except in reverse. Lisa goes and grabs the chart and turns it upside down and then turns around and says,
what do you think of gasoline prices then?
Actually, that's been a very interesting thing. They've actually plateaued, right? Which I think is interesting and will support sort of feeling of positions being anchored. But we're seeing prices go up. What happens if gasoline prices go back up? Is that inflationary or disinflationary?
Well, it's inflationary mechanically because the percentage change is higher, and it does have more of an effect on people's spending behavior. But the bad news is gasoline prices went up over the month of January. The good news is they're going down in February. So when you look at the numbers for the January CPI, you're going to have a little bit of a head fake there. One thing we can say is natural gas prices have gone down significantly. So overall, it's kind of hard to make a prediction for energy prices in general. Oil's up a little bit, gasoline was up a little bit, but natural gas prices way down.
The only certitude we have is the three of us combined know 1/10 of what you know about the National Football League. Super Bowl, help out.
We were talking about that. It's an interesting Super Bowl because you've got two good teams and one great quarterback in Patrick Mahomes, but does America really care as much? It's too small.
I don't sense that
two smaller cities, so you don't get the New
Yeah.
York Giants versus New England Patriots kind of ethos, or even the Los Angeles
Kelly
Rams
Clark
last
said
year.
at the thing last
Philadelphia
night
would
was
love
wearing
you
the
for that,
Dallas
Mike.
Cowboys strap.
Yeah.
Philadelphia's going to love you for that comment.
Well, I mean, I love Philadelphia too, but but I mean, it's not it's not the kind of glamorous media matchup that the networks really
Jalen
love.
Hurts has got a nice story.
He's got a nice story, and he's played very well, and they have overall a very, very strong team, and so you know they're favored now. Kansas City has Patrick Mahomes. So.
Do you think that people would care more if they had Monday off?
Yeah, I don't know. Just do it the following weekend. and just do it on a Sunday and do it the following weekend where you get the Monday off. I don't get it.
There was some pushback, though, because it would take away from President's Day.
That I don't get either, and I'm not going to weigh in too much there. I'd never. Do you celebrate President's Day as if it's like President's Day?
Actually,
we used to.
Really?
John, this is a sore topic.
What year was that?
way back, you had the 12th and the 22nd, and
because we
the
had
22nd was
and you all
usually
got
more
together and
important.
celebrated the presidents.
We were,
Tom did, yeah, we were
did.
all at
Lincoln and Washington, and there was a raging debate when they made it sensibly on a weekend to help families and all that. But to a whole cohort of fossils, it's never been the same as actually celebrating 1809.
Do you go on a communist march for Labor Day? Like, how does this work?
No, we do that May Day.
Oh.
May Day, yeah.
May Day,
Okay.
we do that.
I'm just wondering how seriously you take this stuff. I'm not being insensitive. I mean, seriously.
They parade military vehicles in front of Tom's house on May Day.
Just sounds like this is just a Tom thing. Maybe. Brammer's got things to say. Why are you holding back?
No,
Look, I think that
why
we're
are you
running
letting
out
me
of
drown
time.
here?
Well, no, I
Back me
just,
up.
you
You
look,
don't
I
celebrate
think,
the
no, I
presidents on
celebrate it by the
President's
kids
Day.
getting a week off for
Exactly.
school, and then we go
Next.
off on vacation.
Liverpool. Next.
Steve Paniaker of
Liverpool.
Bain. That is next.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg's Surveillance Super Bowl Friday. Lisa Abramowitz and Tom Keene. There are no two dumber people on network television on the Super Bowl than the two of us. So we're going to do better than that. We've got a lot of coming up here as well. We're wiring up right now with the owner of the Boston Celtics, and he's rumored to do sports. And we'll talk sports with Steve Pagliuca here in a moment. But first, we're going to talk to him about where the money came from, which is a credit market. And to brief you on the credit market right now, S&P futures negative 20. The VIX was out of stick, 21.54. But I'm going to say this. It's a little bit of an exaggeration, but I'm sorry, yields are moving.
Yeah,
I mean, that's the way it is.
Up when it comes to the benchmark 10-year Treasury, when it comes to the benchmark 2-year Treasury. Have we seen the full reset in other assets that really moved on the heels of a downward shift in yields earlier this year? And I think that ultimately is really one of the questions. And Gina Martin Adams spoke to that. She said, no. Stocks have not moved in tandem with some of the reset that we've seen in yields over the past couple of weeks.
And in talking to Apollo yesterday and the stub deal they're doing, I'm going to call it a stub. They're taking a stub off of Credit Suisse and bringing it over. The fancy part of the bond market, not trying to make a coupon, not trying to buy a T-bill, the fancy part of the market is still in huge demand, huge interest.
Well, and this to me is really the question. And we heard from Jim Zelter over at Apollo that this is a golden era for credit, and people are going into private credit at the same breath that a lot of regulators are saying we're still concerned, haven't seen the full shoe to drop in that area. So where does this disconnect get resolved, considering that we saw a huge outgrowth of this entire sector over the past few decades in the low rate era, and now we're embarking in a very different kind of reality?
I mean, and I look at the yield space, and it's wrapped around. I mean, we've been debt ceiling free this week. Thank God for that, even with the State of the Union. But the basic idea here is, and review this, Lisa. Spreads have come in. The troubled part of the market, IG, garbage IG, and this word distress. Those yields are coming in more closer to the 10-year, right?
Well, let's go back to what Gregory Staples was saying, right? He came out of DWS, and he said, you're actually seeing almost frothy credit markets right now. To him, you're seeing the balance of leverage move back to the sellers of the debt. You're seeing spreads come in violently. You're seeing things price really well. So these are sort of the questions. At what point does this indicate that it can't last versus this is, basically the new normal and people are adjusting?
Here's what we're going to do. We're going to talk sports here later in a very generous 25 minutes with Steve Pagliuca. We're thrilled he could join us now. Senior advisor, Bain Capital, not an acquaintance with the only franchise in basketball, Boston Celtics as well. And most importantly, with Jim Zelter, who we spoke to yesterday, the cardinal rule is you can't do fixed income, you can't do debt, if you went to Duke University. You got to go to Duke or you can't do this. Steve, what was in the air at Duke University that got you and Zelter into the debt game?
Well, I'm not really in the debt game. I'm in the private equity business.
Yeah, I know, same thing.
Actually borrow a lot, but Duke's a fantastic place. I'm on the board today, and it's just a great environment and a great learning environment and doing great things.
This moment right now, the jumble that we're in, the day-to-day grind that Bloomberg surveillance does, give us the vision you have out 1 year on the application of all that money in private equity. What are people like you going to do?
Well, I think you got to step back and we're really seeing, I think as you've talked about today, the unwinding of quantitative easing, and we're back to more normalized interest rates. If we look back at my career in the last 40 years, 30 of those years we had interest rates, T-bills were 4.5%, 5%. It's only as of the crisis that we've had this very cheap money, and now that's being kind of unwind, due to the fact when you increase the money supply so much and have so low interest rates, you get speculative behavior and you get inflation. And so now we're in for probably a 10-year cycle of going back to what I'll call normalized interest rates.
In the process of that, I'm curious about the phases of private equity, the phases of taking a company and building it and then cashing in and spinning it off in an IPO. Is it getting harder to cash in and more important to do the due diligence of building up right now at a time when the IPO market hasn't fully recovered?
Well, private equity hasn't totally relied on the IPO market, and the IPO markets are very slow right now. If I step back, I'd say the private equity model, since I've been doing it for, I think, 35 years now, has been a very durable, successful model. And in bad times and good times, because fundamentally what private equity is trying to do is inject capital in businesses and then grow them. It's a misnomer, I think, starting maybe back to the dark days of private equity, that it was just about taking costs out. The really successful private equity companies have driven growth in the technology sector, the medical sector, industrial sector, globalized companies, and the model has really worked well. So again, when I started out, interest rates we were borrowing money at 11 or 12%. So you're seeing corrections in prices now, and we're still able to finance companies. We're still able to grow companies. You just have to become more selective and more fundamental. And now is what a more fundamental market versus the speculative market that was created by the vast increase in the money supply.
Over the past decade, a lot of people have talked about private equity and private investment firms in general taking market share from the bigger banks. And we were speaking with Apollo about the potential acquisition of a Credit Suisse arm. Do you see that increase in taking market share? Do you see that likely to continue over the next few years?
I do. You know, when they broke Glass-Steagall and changed all the rules, the banks have had to be much more conservative, and banks used to be merchant banks, and now they're really just banks. And large private equity firms are becoming more like the merchant banks of the old, and branching out into debt services, branching out into selling and buying of companies. And so I think those private equity firms will continue to go in that direction.
On Bloomberg Radio and Bloomberg Television, Stephen Pagliuca with us right now, of course, owner of the Boston Celtics. We'll get to sport here in a moment and all the different rumors out there, but we stay on global Wall Street. Steve, I love what you say about the merchant banks have become regular banks. Whether it's Goldman Sachs or, frankly, every other bank, there's a competitive effort to keep the spirit going. Some would say Mr. Solomon at Goldman Sachs has stumbled. Did he overreach by doing something that culturally didn't fit Goldman Sachs when he and others invented Marcus and consumer banking efforts?
Well, I think the you know, nobody can get it perfectly. I think they identified that the wealth management market was a great market, and part of the issue is we've seen this great change in interest rates right now, and which made that a tougher strategy. But Goldman has a very good name and a very good reputation, and I'm sure they'll sort that out and be a factor in the money management business because they have the core skills to do that.
Steve, you're just barely old enough to remember when Dire Straits took over the zeitgeist with money for nothing. And as you mentioned in your last answer, all of a sudden money costs something. The Dire Straits rate structure is so over. How does the private equity market change? Speak to the young Turks now in private equity. How does their world change now that money costs something?
Well, I think the world changes in that there was in the last 5 to 10 years, as we've talked, there was a speculative bubble where people believed that everything could be Amazon, that the weight of money and putting money into growth capital companies would gain share, and you could lose money for a long period of time. When money is cheap, you probably can do that, and there were successful investments like Uber and Amazon. But for every one of those, there's been a lot of ones that are just will never achieve the potential. And when you change interest rates, the value plummets, and you've seen that now in the tech market. So I think we're going to go back to the future. When I started, interest rates were, T-bills were 5%. And as I told you, we were borrowing at 10 and 11%, and we were very successful. But you have to kind of go back to fundamentals and have companies that gain share and become profitable, because you can't take the strategy of losing money for 5 to 10 to 15 years to then create a great business at the end. It doesn't work in a world where money costs something.
Over the past decade, Steve, we were talking about companies that would borrow money to pay their stockholders, right? There was a lot of discussion around that, and it seemed like the debt side was less valuable than the equity side in many ways because you would get rewarded by the bond side, even in the equity space. Has that balance shifted? Do you see a greater opportunity on the bond side now, on the credit side of the companies that you invest in, than the equity, or is it just more balanced?
It's more balanced. There's always going to be bigger returns where you create more alpha in equity by driving and increasing companies' market share and profits. But I would say we are entering kind of a golden age of credit. where now credit's being appropriately priced, and people are getting great returns on that credit. And it's really, I wouldn't even say it's expensive. It's more of a normal cycle behavior now. We looked at this at Bain Capital. All economies where the money supply increased kind of 50% or more, which is what's happened in most of the Western world. After a period of time, you see large inflation, and it's got to be corrected, and it's got to go back to kind of where the cost of capital is more normalized, and that's what we're seeing right now, and that's going to be a 10-year trend.
Stephen, on the Super Bowl weekend, it's just wonderful that you've agreed to stay with us in our next segment, folks. This will be really most interesting. I want to touch on sports here. I think of Malcolm Glazer, what he did out of Rochester, New York, buying the Tampa Bay Buccaneers years ago. That was an entrepreneurial guy, starting with his father with next to nothing, who made it big in sports. The illusion today is, or the reality, I should say, is there's the haves and have-nots of sports, of big money, whether it's petrodollar money or American tycoon money taking over sports. How do you adapt and adjust to that to do the social good of what a domestic economy wants? Let's take English football. How do the big guys come into English football, like the Saudis in Newcastle, and yet support the domestic people of the United Kingdom?
Well, that's a long, complicated answer. I have experience having been the owner of Atalanta in Italy, and sports can actually be a fantastic change for social good. In terms of specifically the structure of soccer or what they call football in Europe, it is much more grassroots. It's much more teams can kind of come up and down. And I think what these new owners have to do is recognize their community asset and both try to win, but share the spoils with the teams on the bottom. And I think the UK just came out with a large regulatory report in terms of reforming the system, where more money will go to the smaller teams so they can feed the larger teams. Mm-hmm. And then secondly, what's been great about the USA as a leading model is the NBA has NBA Cares, the Boston Celtics. We formed the Boston Celtics United for Social Justice and the Boston Celtics Shamrock Foundation. And we've given millions of dollars back to the community and worked with the community and had our players go out there as well. So sports franchises can be a real impact for social good. And then specifically in the question on the European leagues, it is different than the U.S. It's a grassroots basis. Yes. And they're looking at the rules and regulations to really make it be more fair and really support those teams.
On the Super Bowl weekend, we're thrilled to bring you Stephen Peglica. We'll come back and drive this conversation forward. He is the owner of the Boston Celtics and the most storied court in basketball. Stay with us. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The death toll from those earthquakes in Turkey and Syria has now risen to more than 22,000. Experts fear tens of thousands more people are buried under the rubble. Turkish President Erdogan is facing mounting criticism over the country's poor construction record. He has also been criticized for the government's response to the quakes. China is accusing the U.S. of exaggerating the dispute over a balloon shot down off the coast of South Carolina. The Biden administration says it was conducting surveillance and has offered evidence it says backs that up. Today, China's foreign ministry again said the balloon was used for civilian use. Bloomberg has learned that Fox has turned down offers of more than $2 billion for its Tubi streaming service. That is more than 4 times what it paid for the business. Fox CEO Lachlan Murdoch wants to keep Tubi because of its fast growth. Tubi is a free ad-supported service, and it's free online TV that is really bringing in the viewers these days. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
Buy a book about YouTube now. Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is the golden era for private credit. You know, rates have been rising. Economy is doing pretty well. You can get double-digit yields. This is easily the best time to be an investor in new issue vintage credit. The best that I've been here 17, 18 years. You know, you're getting double-digit returns by lending at the top of the capital structure.
From Duke University, Jim Zelter with us here on debt, and of course on private equity. We're talking to Steve Pagliuca right now, of course, with Bain Capital and co-owner of the Boston Celtics. Lisa Bramwitz and Tom Keene doing a little bit of a wonderful sports vamp here. We'll do this right now with Steve. And with that, we need to bring in someone encyclopedic on PAG's Boston Celtics, which, of course, for me, always Michael McKee is the romance of Mr. Arbach, and an absolutely original floor and Bob Cousy and what he did long ago and far away. But you are way up to speed on the new Celtics. A couple piercing questions here for Steve right now.
Well, let's just get this out of the way and ask you about yesterday. Mike Muscala coming to the Celtics. You guys didn't do much beyond that. And there was sort of an expectation you might package some of the players or draft picks and pick up some of the stars that have been floating around. You're satisfied just being the best team in the NBA right now, I guess.
Well, we have a great group of players, high character, probably one of the tightest groups we've had in the 20 years that we've been involved with the Celtics, and made it to almost won the NBA Finals last year. We added Malcolm Brogdon, who's been a major plus. So that group is leading the NBA right now, and now we've got some more help with Mike Muscala, and excited about him. So I think we're in pretty good position. As long as we stay healthy, we're in pretty good position for the rest of the season.
A very quick question here, just because everybody wants to know. Jaylen Brown, how long is he out?
You know, he's still being evaluated. Hopefully he'll be back in a few weeks. And you know, we basically won't put players out there if they can be injured. So the doctors are looking at the best course of action, but he'll be back at some point soon.
I got to ask this question. Matt Ishiba walks out of the Board of Governors meeting, shaking hands, new owner of the Phoenix Suns, and a couple hours later mortgages that franchise to get Kevin Durant. Is that the kind of move that is good for the NBA?
I think it's exciting. You can see it's caused a national stir. It's created a powerhouse out in Phoenix. The issue in the balancing act that you always have to do as a sports franchise owner is the long term versus the short term. And it sounds like, you know, Matt has a philosophy that they have a team that's on the cusp, and adding a star like Kevin Durant is worth it to mortgage the future. And we'll see how that pans out.
Steve, we got to turn to all the rumors that are out there and drive the conversation forward. And of course, been briefed by Jonathan Farrow, who truly brings real expertise here. There is an American interest in the Premier League, which I'm speaking as an amateur, is the best run league in the world, or the most effective league in the world. It seems like every Saturday is a World Cup on NBC. And I'm looking at Manchester United and all the turmoil there. I'm looking at the new ownership of Chelsea As you look, as rumored, to Liverpool, what did you learn from the Chelsea ballet? What did you learn in the last number of months about how a guy like you from Bain approaches the Premier League of the United Kingdom?
Learned a lot. It was a great learning experience, and it is a fantastic league. As you know, I'm the co-owner and chairman of Atalanta, which is in Serie A, which is a fantastic league as well. So we've learned a lot from that and the Premier League. I think the Premier League has very high values because it's a fantastic product. The television revenues are high. It attracts great players. Now, the Chelsea situation, the price was really a very, very full price, and I think that's motivated some other teams, as you've seen, to try and sell. And I don't know if that value is going to be justified for all the other teams. Long-term, sports is a great investment because you've seen it go up year after year after year. It's the only property on television that is must-see TV. And as the whole TV market has changed from linear to digital and now bundling and unbundling and streaming, these sports products have become even more valuable. So there's a bright future ahead.
Steve, a viewer question. John from Milan emails in and says, can Atalanta, can they really do better than AC Milan through the rest of the season? Your thoughts on that, please.
We're very excited about Atalanta. The Bacassi family and the scouts have done a fantastic job bringing in a lot of young players who are very heralded. We have the second leading goal scorer in Serie A, in Lookman, Adamola Lookman, and Højlund is a young, now just turned 20 player that's making an impact as well. So hopefully we can be very competitive and be at the top of the league. We have a big game on this weekend, and hopefully we'll win that one.
You know, I feel like, Elisa, it's like when the manager in baseball is banished from the dugout and they're calling on the phone to tell what the plays are. Pharaoh's in my ear. Yeah, like, ask about AC Milan.
Yeah, exactly.
Ask
Please.
about AC Milan.
You're going to bid on them, make them better? No, I want to just build on what you were saying, Steve, this idea that sports products are really attractive to you and that the asset class is growing. And I'm curious what the analog is in terms of owning a sports team, whether it's for the revenues, whether it's for the advertising, whether it's for the social presence, and how you evaluate that. What kinds of investors are appropriate for this area?
Well, you've seen massive increases in sports franchise values across the board, and really that's because they hold value and because the promise of television revenues and basically branding has been fulfilled over a long period of time. They've created large fan bases. Technology has really changed everything. It's globalized these sports franchises. So when we were growing up, you really couldn't see a soccer game in London. Now you can see it all over the world. And the big sports teams, including the NBA and soccer, which are both global sports, are now counting fans in the hundreds of millions rather than in the millions. And you can use that brand power to monetize it for the sports clubs. Secondly, there is a almost Picasso painting-like aspect of this. There are only 30 pro teams in every sport in the U.S. and there's 4 or 5 big leagues, so it's a very scarce asset globally. Franchises, companies like Chelsea, clubs like Chelsea are very unique in the middle of London there, and so there is a intrinsic scarcity value plus an economic value of the properties because of the television revenues and the central role that they play in attracting viewers in the larger competition, as you see YouTube, Apple, and other tech companies now encroaching on the broadcast space.
Just real quick here, Steve. I'm curious whether Middle East money has pushed out other bidders right now from the London clubs.
You're seeing institutional capital come in, and with these kind of values, that is going to happen. And they have strategic interest in I think, building the brands of those countries. Right. And so they're just another factor, right. Another source of capital.
Steve, I got to ask one more delicate question here, and I say it with great respect for the way you've done sports. There's a massive uproar about Man City. I was making jokes the other day. It was far more serious than anything we saw with the Houston Astros. How do guys like you help with the arms race and the outcomes that are alleged at Manchester City?
Well, I'm not involved in the Premier League, but if I step back in general, I think a good model would be the NBA.
At Manchester City.
Well, I'm not involved in the Premier League, but if I step back in general, I think a good model would be the NBA, where Adam Silver and previous to him, David Stern, have done a fantastic job in enforcing, fair play rules and making sure everybody has a level competitive field. And that's really the way to do it. And I applaud the Premier League and Serie A for doing the same thing and really enforcing everybody playing by the rules, because at the end of the day, no one wants to have unfair competition or watch unfair competition or have people who are bending the rules or violating the rules succeed. Right. And that's fundamental to fairness in sports.
Right. Steve, I got all of 10 seconds. Eagles or Chiefs?
I love Mahomes, so I'll say Chiefs.
Very good. Steve Vex, thank you so much. Greatly appreciated with Bain Capital and with the Boston Celtics as well. And we thank Michael McKee as well for piercing questions.
For knowledge that we don't have. Let's just call it what it is.
We thank John Farrell for Farrell's in my ear through the whole thing. Ask him about
I want to give him some advice, though. We went to Copley Square for the NBA Finals last year, and they had TVs set up. They need bigger ones, because it was so crowded.
You're saying Steve failed. You should have asked that question.
Yeah, PAGS needs to get bigger TVs in Copley for the NBA Finals.
We hope you have a great, great weekend as we celebrate American football sport. We've got much more coming up here. Really, really important day here with good conversation to get you to the weekend. Richard Haas at 12 noon, a wonderful new book.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
Top-end venture is sort of 3x net of fees. Ideally, you're hoping for more than that. You're hoping for 5x or more. You're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
We are set for the biggest weekly loss on the S&P 500 on the year so far. On the Nasdaq, we are set for the first weekly loss of the year so far. Equity futures right now down 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York coming up, looking ahead to next week's inflation print, crude climbing as Russia gets set to cut output, and Japan closing in on its next central bank chief. We begin with the big issue, CPI in America.
We have CPI looming next week.
We have a big CPI report coming up next week.
That CPI print is kind of a sneaky risk event.
Chair Powell essentially is telling us they're data dependent.
He basically said, all right, you guys want to play data dependent? We'll play data dependent.
Investors have largely assumed away inflation risk.
A good CPI report, which again will just increase this sort of pain trade, increase this sort of turn up in the fundamentals.
If you were to get a little bit of a surprising print there,
We could get some more bumpy inflation news.
it's the kind of thing that could A, disrupt the rally, and B, I think embolden people to kind of lean against the rally we've seen.
It's not clean sailing for the markets.
CPI is going to be interesting.
Valentine's Day, it's all that matters. CPI, Tuesday morning. Joining us now, Pictet's Ella Hodger, Morgan Stanley's Matt Hornback. To both of you, thanks for being with us. Ella, first to you. CPI, your words, next week, Valentine's gift or massacre? Which one is it?
Well, we'd say probably the odds are skewed to a slightly softer print, and that's, all of the stuff we've been talking about for the last 3-4 months, base effects, supply constraints, easing off. So it's just sheer mathematics. So there is a risk that it comes on the softer side, which I guess for markets is the gift of Valentine's. But of course, for a portfolio manager, you always worry, particularly on the bond side, for how things can go wrong. And certainly, given the rally we've had across the board over the last 3 months, and particularly year to date, there is, of course, a skew that if the number does come on the higher side, we can have a bit of a nasty reaction similar to what we got after the non-farm payrolls data last Friday. So we're certainly tilting portfolios to be sensitive to that risk.
Well, especially after the payrolls report this time last week. Matt, with that in mind, what's in store on Tuesday?
Well, John, our economists, who are led by Ellen Zentner, our chief U.S. economist, they're looking for a 0.4 out of the core CPI number, and that's in line with consensus, John. I think it's notable, though, that in the wake of the labor market report last week, we did see economists begin to revise higher their expectations for CPI. And we also know, and it's now a well-known factoid, that January CPI has surprised in 9 of the past 10 years to the upside. So, investors, I do think, are concerned that this number could be a spicy one on Valentine's Day.
Pushing that data through the bond market. I'll leave that one there, Matt. We'll explore that at another time. Your 2-year yield this time last week, 4.09%. We're 40 basis points higher than we were last week. Ella, I know that for you think there's still some risk at the front end. How much risk? How much risk is there, upside risk, to higher DM terminal rates?
John,
Well, if you...
That was for you, Ella. Take it away.
Yes, of course. Thanks, John. Okay, so because of the risks that we face from the NFP data and because of this tilt that we were saying that markets are much more sensitive to a higher print, that makes the front end especially vulnerable. And that's exactly why you've had the reaction that you've had since last week in the 2-year part of the curve. If you model 3 different economic scenarios, i.e. the sort of, the Goldilocks that we've been playing so far, or this scenario where growth is a lot better, but that means you have to price in a tighter Fed, or this other scenario, which is the calamity one, which the markets were freaking out about last year. If of those 3 scenarios, there's only one where the front end is a bit more supported. So if you probabilistically weight it, you certainly would have more skew for upside in the front end. And this is kind of like what makes us stay away from that. So that still, on the 3 scenarios, makes the long end of the curve more attractive, certainly over the course of this year. So we like to have a tilt to that. So we still like US rates, but we're cautious of the front end.
So, Matt, you've got the 2-year, I think, at 3.25, the 10-year at 3. Are they still the calls for this year?
John, those are still the calls. Our economists don't think that the January number disrupted the overall trend in payrolls, which is to weaker numbers as we make our way through 2023, and that makes sense, I think. So as the labor market continues to slow, I mean, bear in mind, John, that the Fed doesn't think we've really seen peak tightness come through and hit the economy. That makes perfect sense in light of these backward revisions to 2022. It doesn't really look like the tightening in monetary policy last year really began to impact the broader economy. So 2023 is when that should happen, John. That's what we're expecting.
We'll see. I mean, that's the call from Matt, and who am I to say it's wrong? At this point, we're seeing stronger data. No landing is a theme I keep hearing about from a lot of people. Really, this conversation started with Neil Dutter of Renaissance Macro coming into 2023. Torsten Slock of Apollo jumping on board. He said no landing in an email to me this morning. That's his base case now. He went on to say inflation will be sticky, the Fed has more work to do, and more demand destruction is needed. Ella, what do you make of that, this no landing theme?
I mean, certainly we've had corroboration of that theme so far. If I may recall, back in 2006, 2007, you know, a very sort of important pinnacle for markets back then. It was a similar scenario. We started to get some data that showed that things weren't as bad as we thought after the Fed having tightened so much. And of course, we know what happened later down the road. So it's not clear to us. I mean, this is a very difficult macro environment to navigate. You can tilt from one pendulum swing to the other. And so you have to navigate very carefully. Now, so far, the data seems okay, but you do have to take a bit of a broader time frame and an historical time frame on this. When we have this level of tightening in the market, eventually it does end up slowing down the economy, right? And we've had quite the fastest pace of hiking from the Fed, as well as tightening of liquidity. So down the road, most bond managers will tell you this does lead to a more of a recessionary outcome.
I keep returning to that line from Julian Emmanuel of Evercore earlier this week. If you're not confused, you're not paying attention. Equity futures right now down 0.5%. Mike McKee's paying attention. I don't know if he's confused. Mike McKee next week, CPI, after that blowout payrolls report this time last week.
Yeah, I'm coming in to be your little black cloud today. We have some bad news for you ahead with the CPI numbers because they're not going to be as good as they have been, and this may just add to the whole pressure on the markets to decide what the Fed is going to do. Take a look here. The bad news is we're expecting the headline CPI to go up by 0.5%. It went down 0.1% in December. Core at 0.3 unchanged, but still both of those are showing no sequential improvement to the Fed, and in the case of the headline, a much worse outcome. So do we get that? There's a good chance of it, and here's why. The BLS is changing the CPI category weighting starting this month. They used to do it every 10 years, change the weights in the categories, how much each purchase matters to people. Now they're moving it to, well, they moved it to 2 years. Now they're moving it to 1 year, which will be good in the long run because it'll give us a quicker look at what people are actually paying for. But according to Omar Sharif of Inflation Insights, he says it could boost the core this month by 2 to 3 basis points, which would not be seen as good news in a maybe non-discriminating market that doesn't look as closely. We know gasoline prices rose in January. Used car prices rose in January. So there is an upside risk to CPI. And then the question is, what does the Fed do about it and how does the market react to that? Well, the Fed has kind of preemptively told us. Jay Powell on Tuesday said, we are going to need to do further rate increases. And then everybody else on the Fed who spoke this week, we can summarize their remarks by saying, yeah, what he said. They're all saying we're going to raise rates some more and we're going to leave them high. Does that mean you need to push up your bets on the 2-year, push down the 10-year, steepen that curve even more? You guys are going to have to decide that out there, but that seems to be the trade at the moment.
Mike, you're awesome, phenomenal, as always. And to Mike's point, it looks like the path is set for the next couple of meetings for this Federal Reserve. It's what happens after that. We caught up with a guest this morning from Bloomberg Surveillance who said the disinflationary process may well look like it started, but once you get to the summer, you might have a bit of a problem. We'll have a debate about it maybe being stickier. David Leibovitz of JP Morgan yesterday morning said to us on the same program, he said he thinks disinflation is going to go back on the shelf with transitory. Now, I just wonder, Matt Hornback, what the pushback is against that later this year.
Well, John, the pushback is pretty straightforward. Despite what now appears to be a much stronger labor market in 2022, We still had sequential declines in wage inflation starting from the first quarter of 2022. If you look at the ECI and the quarterly numbers that have come out and you annualize them, they've been declining since the first quarter of last year. We had a peak in headline and core measures of inflation in the fourth quarter, in the third quarter of last year, John. That's despite what now appears to be a much stronger labor market. If these forecasters believe that the economy is going to produce 300,000 jobs a month for the next 12 months, fine, we can talk about inflation reaccelerating. But John, that's not likely to happen. Inflation is likely to continue to slow.
Alarian had this to say in Project Syndicate this week. As inflation gradually eases, the claim that today's inflationary pressures are the result of a temporary supply shock has re-emerged. It could also encourage dangerous complacency, making an already serious problem much harder to solve. Ella, do you think the word transitory is coming back maybe a little too prematurely?
Well, we may find some of those supply issues that we were talking about last year turn out to be transitory, but like that transitory period is more like 18 months as opposed to what the Fed was expecting. I don't know, John. I don't have the magical answer. All we know is basically that maybe just that's not the thing to focus on right now. Maybe the thing to focus on is exactly wages and the tight labor market, because famous last words, but there is something different about the labor market now. And that is basically that it's a tight labor market. There was a good chunk of the employment base that left during the pandemic and has not returned. And so that's what's making the job of the Fed very, very tricky. So this wages numbers are important, and they might take some time to come down. So that's what worries bond markets with this analogy of higher for longer, which is certainly a new theme for bond markets.
Well, let's pick up on that labour market story, Matt. I just want to finish on that with you. What's your degree of confidence, your level of confidence around the labour market story? Just the post-pandemic realities of this labour market in America.
I mean, John, I think the confidence comes from the idea that it's going to be very difficult for the economy to produce the same number of jobs with much tighter monetary policy coming through over the course of the year. The idea that policy operates with lags, I think, is a very reasonable one. And the idea that the tightening the Fed put into place last year didn't quite have much of an impact on the economy last year is also very reasonable. So the idea that we're going to be producing 300,000 jobs a month, despite 5% plus interest rates in the U.S., just baffles me. I don't see how that's possible.
That's the debate right now, at least. Matt Hornback, thank you, sir. Alongside Ella Hodger, they'll be sticking with us. Looking at the rally in crude this morning, it faced just a little bit. We're up 0.9% on WTI, on Brent up more than 1%. Coming up, Russia cutting its output.
1 million barrels per day more from China, 1 million barrels per day less from the SPR. That's a swing of 2 million barrels per day. I think the market's too focused on Russia. The other two alone can take us to $100.
Well, that focus is back on Russia. 500,000 barrels a day set to be cut from next month, and we understand OPEC Plus is not ready to step in. That conversation up next.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now, we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Oil prices, we know they are critical to the formation of inflation expectations among households, and central banks have been very focused on that. Russia, with this cut, the reply by OPEC, more demand from China, especially as mobility increase. This could complicate matters, and in a market that's already priced that inflation will be back down almost to central bank target by the end of this year, could prove wrong.
Russia pushing back against international sanctions, announcing plans to cut oil production by 500,000 barrels a day. The Deputy Prime Minister Alexander Novak saying the following: the mechanism of price caps on Russian crude and petroleum products is an intervention in market relations and an extension of destructive energy policies of the collective West. This as OPEC Plus signals it's not filling the gap, briefly pushing prices close to $87 a barrel on Brent. The team coverage with two of the best starts right now with Paul Wallace out of Dubai and Will Kennedy in London. Paul, talk to me, just frame this one, what we've heard from Russia and what you're hearing from OPEC Plus.
Hi, John. So there was a bit of a jump in oil prices earlier today when Russia made this announcement that it's going to cut crude production by 500,000 barrels a day from next month. Oil went up to almost $87 a barrel, about almost 3% higher. This was flagged by Novak, Alexander Novak, Russia's sort of oil chief, late last year. In December, he actually said that Russia was looking at 500,000 to 700,000 barrels a day of cuts in early 2023. But of course, there must have been some people in the market that didn't expect that to happen. And now it has. Oil has pared some of its gains, though. So I think some people have dialed back those bets on how much sort of turmoil this is going to cause in the oil market.
Paul, with that in mind, what's the logic behind OPEC Plus and a couple of delegates telling Bloomberg maybe that they're not going to fill the gap? What's the logic behind that?
This has been their thinking for at least some weeks now, that they see the oil market as being balanced, and it's increasingly clear that they don't want to raise production until at least 2024. Many people in the market who had expect them to start raising output earlier than that, probably around June or July or August. I think for the moment they're going to stay put. At least that's what we're hearing, and the reason is they're saying they need to see evidence of a market being out of balance before they move on anything. So far, today's announcement isn't enough in and of itself to cause that. I guess we'll see in the coming weeks if it is enough to
some people might be surprised by the potential for consequences of this decision, Will Kennedy, because I think some people don't quite realize how much Russian crude is still on the market, still being consumed every single day. How significant is this?
Well, you're exactly right. Russia had been producing almost 11 million barrels a day. Production had fell in the immediate aftermath of the invasion and recovered steadily, and that puts it well ahead of Saudi Arabia in recent months, for example. So that had been one of the reasons why oil had stayed fairly subdued over the last few weeks. But I think it really can make a difference, and especially when you look at the factors that you had Henri Tassem describing earlier, which is increased Chinese demand as the economy reopens and less oil out of the US SPR. And you put that together with the other theme that's been on your program of an economy that's stronger than many people expected and not slowing down. And as Amrita said, it can become a pretty bullish brew quite quickly.
We've got that right now, at least this week, up about 8%, I think, on the week so far. Will Kennedy, Paul Wallace, two of the very best from our team on commodities, breaking it down for you. The potential for 500,000 barrels a day to be cut from output out of Russia, and the lack of potential for OPEC Plus to step up and offset this. Bullish crude seems to be the view from UBS right now. Lower Russian crude production, together with China's reopening, should tighten the oil market further over the coming quarters. The team goes on to say, we advise risk-taking investors to add long exposure Crude right now, WTI 78, Brent 85. Back with us, Matt Hornback, Ella Hodger. Ella, I thought we'd be focused on the demand side in crude with China reopening. This morning we're focused on the supply side. But let's touch on demand. China reopening. How are you thinking about that theme going through the rest of this year?
It's a very important theme for markets because a lot of this delta global growth over the past, we can say 10 years or so, has been coming from China. And so the reopening is a different one, at least for us, in terms of how it plays out this time around. It's far more consumption-led, therefore far more domestic in nature. It will leak outside, and it tends to leak through travel and tourism and those that will export into this Chinese consumer. But the delta, we believe, is likely to be lower. And so with markets having played out this China reopening thing for the last three months, there are risks that we get disappointment. And so I know that's not what a lot of people want to hear, but to us, that's what seems likely. So that's on the demand side. More broadly, for commodities, the supply side will matter, once we get some more clarity on this short-term tactical demand aspect. More broadly down the line, commodities are supported. So for a lot of the global money managers, it is certainly an asset class that they want to have exposure to. And in terms of currencies, particularly to fixed income, commodity currencies over the medium to long term do offer some value and protection to portfolios.
To your point on the potential for disappointment, looking out to 23, consensus forecast for China GDP is 5.1%, the year after 5%. Milken's Bill Lee said the same thing this morning. He thinks that maybe you get a downside surprise on GDP. And Matt Hornback, he also suggested the potential for leakage, spillover, positive spillover from a better growth story. He doesn't think it's that great. Where are you on that?
Well, John, I mean, I think when we look at the growth impulse coming out of China, it clearly helps Asia the most out of any of the regions around the world. Next would probably be Europe, and then a distant third would be the U.S. So from our perspective, we're not really expecting much of the growth impulse to benefit growth here in the United States, John.
Matt, where does that leave the dollar call?
So medium term to long term, we still think the dollar has a decent amount of downside. More tactically, of course, in the wake of the payroll revisions and the upcoming CPI report, it becomes a bit trickier. But certainly medium term, we think if the U.S. growth picture improves further in 2023, unlikely we think, but if it happens, then that's an environment where the dollar can continue to go down, John. You're going to have a growth impulse out of China, good growth in the U.S., and rebounding growth in Europe. That's a recipe for dollar weakness.
Ella, are you taking the other side of that?
I do, I'm afraid. And that's because I think the story that Matt's describing is what's been playing out already. We reached very toppish levels of the dollar. Everybody got long because we were all scared of the big bad recession. And now that's sort of taken, the Dixie index that you're flagging here, at least 50% lower thus far. And so to us, a lot of those positions have been cleaned out. Yet we have a tight dollar backdrop, right? So when you look at the central bank liquidity, the dollar is the one that's actually lacking. So compared to the euro and the yen. So for us, that interest rate differential story has played out now. Europe and Japan potentially catching on to that. And so that to us means that the dollar plays a really important role in a portfolio in terms of hedging you versus those scary risks we talked about, i.e. either global growth disappoints, in which case the dollar we think will perform, or the other risk, which is, things are quite hunky-dory in the U.S. and therefore the Fed needs to stay tighter for longer. So we actually have been increasing exposures to our portfolio in dollars. So we have been scaling back those for the last 3 months. And now we actually like owning some dollars. We think it's in a good spot to go higher. Yeah.
Ella, thank you for being with us and for that call on the dollar. Ella Hodger there, Matt Hornback, the two of you. Thank you. Thank you, Matt, as always, buddy. Man United, let's bring up the stock quickly. Stock's down about 5% in the pre-market. The latest from ESPN. This according to sources. Man United's potential bidders unsure that the Glazer family wants a full sale. That stock just dropping going into the opening bell. I'll pick up on that a little bit later. Up next, your morning calls, and later, Lyft getting absolutely crushed.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Losses fading into the opening bell. Let's get you some morning calls. First up, Mizuho upgrading Micron, citing improving structural trends in the memory market. Stifel upgrading VF Corp, seeing an attractive valuation following recent declines. And finally, Citi downgrading Lyft to neutral, expecting the competitive environment to continue. That stock getting absolutely hammered. Coming up, we'll pick up on the Lyft story, and we'll go to JP Morgan's David Kelly on why he thinks investors should play a growth slowdown.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg.
24 seconds away from the opening bow this morning. Good morning to you. Equity futures lower by a third of 1% on the S&P. On the Nasdaq, down 0.75% on the S&P, heading towards the biggest weekly loss of the year so far. On the Nasdaq 100, heading towards the first weekly loss of the year so far. Futures a bit softer. There's your opening bow. Switch at the board and get to the bond market. Yields near the highs of the year, just sub 370 on a 10-year, 368.26. Yields up 2 basis points on a 2-year, through 450. We closed out 2022 at 442, and right now 447. But this morning through 450, going into CPI on Tuesday. In the FX market, euro dollar negative 0.4%, back to 106, 107 right now at 106.98. And that crude rally, it fades just a little bit. Been pretty powerful through the week, still up by 7 to 8% or so on WTI, just short of 80, $78 and about 90 cents at 1% on the session. About 30 seconds into this session, we're down 0.2% on the S&P. On the Nasdaq, we're down 5 or 0.6%. One stock to watch at the open. Check out Lyft, flirting with its biggest one-day decline on record after issuing disappointing guidance. The CEO, Logan Green, saying the following: the company is reviewing adjustments to the business, including cost-cutting measures. Mandeep Singh, we're down 31%. And Mandeep, I have to say, you flagged it a little bit earlier this week.
Yeah, and look, I think the fact that CEO is talking about cost cutting when your competitor is growing north of 35%, it's not a good sign that they're focused on, cash burn right now. And Uber specifically talked about their incremental margins being 12%. In the case of Lyft, they're negative. So what it tells you is even though they grew in the quarter, they had all sorts of problem on the cost side, whether it was insurance or just adding driver supply, and that's not a good healthy marketplace. So clearly scale is an issue for Lyft, and right now they are too focused on cost cutting when your competitor is taking market share.
Mandeep, why are their fates so different right now? What does Uber have that Lyft doesn't?
So Lyft has more of a West Coast exposure, and they talked about, West Coast being slow to come back in terms of reopenings and just the volume of rides. I do think they didn't focus as much on the supply aspect that Uber got it right. And Uber was somewhat helped by bundling delivery. So right now, think of, how many subscriptions a customer can have. You can have an Uber subscription, DoorDash, Lyft. You can't have all of those. And what Uber did was they bundled everything. And if you had to pick one, chances are consumers are going to go with an Uber subscription as opposed to the others that are offering. And that is where scale matters. I think that's the only mode in this business is scale.
Mandeep, is it too early to say there will only be one winner here in the US and there just isn't space for two?
I mean, it was a duopoly, but the duopoly wasn't even. And I do think Uber is gaining at least 1 to 2 percentage points of market share every quarter. So right now it was 70-30. I think in the next few quarters, it will probably be 80-20 if I had to take a guess. And that will force Lyft to consider strategic options.
What are those strategic options? Well, talk to me about it. Who would be the buyer?
Well, it could be any of the large tech companies that is trying to play the autonomous theme. So Lyft still has a network where you could deploy those cars. And I think that's where it gets interesting because you need the data in terms of, how the routes are, what sort of demand there is. And to my mind, whether it's level 3, 4, or 5, if you are trying to play the theme of autonomous, as a car maker, you have to think about how to deploy it, and the ride-sharing companies are perfect for that. So Lyft still has a network that is valuable for any car company trying to deploy autonomous driving.
What a move. Mandeep, great work this week. Appreciate it, sir, as always. Mandeep Singh there of Bloomberg Intelligence. Look at the name, Lyft, getting hammered, down 33%. Close here, biggest one-day decline ever. Frame it this way, though. Close the year 2022 at 11. Right now, 10.84. We'd rallied by more than 40% year to date. We've wiped it all out, just like that, in 3 or 4 minutes. Brutal stuff for that stock. Bit of a mixed picture for PayPal. Let's pick up on that company. The company reporting better than expected guidance on the back of a slow growth quarter. Ed on the West Coast with more. Hey, Ed.
Yeah, good morning, Jonathan. Happy Friday. The market, as you say, is kind of weighing both negatives and positives. The negatives are that payments volumes did drop faster than expected in the holiday quarter, slowed down faster than expected. So the top line picture's murky, and they didn't give full year guidance on the top line. But cost cutting seems to be working in the market, at least this Friday, cheering the EPS guidance that this year earnings per share will climb to $4.87, 18% gain. I think the street was looking for something like $4.75 for the full year period. Dan Schulman, longtime CEO, will retire at the end of this year, so that is another factor. This is a stock that a year ago was trading at $120 a share, but the other way of looking at it is its valuation relative to major benchmarks, how attractive it is. It's interesting because you can take two inferences from it, right, John? You can say, okay, gross payments on the platform are really slowing down. That's a worrying sign in a holiday quarter for the consumer, but there's still growth there, even if it's slowing. It's just we didn't get a firmer guide on the top line. One important development this morning, John, we've had a regulatory filing this morning that has disclosed a probe. The Consumer Financial Protection Bureau has asked PayPal for information on how it treats customers who have accidentally sent a Venmo payment to someone that they didn't mean to. I don't know if you're a Venmo user. This is something that I've experienced, but kind of a PSA for anyone out there that uses Venmo. The regulators are looking into this.
Someone sent me money on accident once. Not a big number, something like $15, $20.
Tom Keane.
They took it back pretty quickly. Now, TK never sends me money, Ed, never. Ed, can I finish on this important question?
Sure.
For you and I both, is it Adidas for you or Adidas?
Adidas.
Still Adidas?
Yeah.
Do you remember we were kids and we called Nike Nike in the UK?
Nike, yeah.
Yeah, that doesn't work here at all. Ed, thank you.
Brits in the US, yeah.
On the West Coast, Ed Ludlow, Adidas. Should we talk about Adidas? Let's do that right now. The stock under pressure, getting hammered in Germany, as the company warns of a €700 million loss from its fallout with rapper Kanye West. Ollie Crook out of Berlin joins us now with more. Hey, Ollie.
John, it's remarkable the impact that a single partnership can have on a company the size of Adidas. You know, we knew it was going to be bad going into this, but the price action this morning just tells you that we did not know how bad it was going to be. So Adidas was as recently as, before October when they had to dissolve the relationship, calling this the most successful partnership in the industry's history. It's saying it's going to cost them 1.2 billion euros in revenue this year. And that's an even bigger problem for profit. These are high margin items, the Yeezy line. According to some analysts, it accounts for about half of Adidas's total profit. And these relationships really are the magic for companies like Adidas. You know, they have other partnerships like the Ivy Park brand with Beyonce, but the Wall Street Journal overnight saying that sales from that brand fell 50% last year. So even with someone like Beyonce, it's no guarantee, and it's a story being told in the stock today, but it's also a story being told longer term, Nike versus Adidas. At the beginning of the pandemic, there was a $60 billion market cap spread between these two companies. This morning, it's $160 billion.
You notice how Ollie uses both pronunciations because he came from Brooklyn and went to Berlin. So now he's doing both Adidas and Adidas. Ollie,
I'm hedged.
You're hedged? You're going to pick one?
I have to go Adidas. It is correct, I'm afraid to say.
That's the correct way of doing it because you're in Berlin now. Ollie, thank you. Good to catch up, mate. As always, Ollie Crook there out of Berlin on the latest with Adidas. I live here and I just don't care enough to say Adidas all the time. We need to talk about layoffs too. News Corp, Lionsgate, Canopy Growth. Abby, it's just been name after name after name again this week.
It really has been. And this is really the theme of this year, layoffs, primarily in tech, but now it is starting to spread out a little bit. Relative to some of those big tech names, though, we're talking about the biggest of them, Salesforce, Alphabet, Amazon, Microsoft, Dell. Microsoft layoffs have already begun, actually, starting just yesterday. In total, 10,000 jobs are to be cut. They're offering very generous severance packages. Now, probably the jobs yesterday having to do with an Army goggles contract that was reduced. But News Corp and Canopy Growth, to your point, big layoffs. Canopy is laying off 60% of its workforce, or 800 jobs. It has everything to do with the bad quarter. Both of these companies put up bad quarters, with EBITDA sliding by 30%, sales sliding. So this is probably less a matter of the over-hiring that we've seen so much for technology, and more having to do with fundamental demand. Now, that has been a theme for technology, too. But interestingly, John, we have this divide where we have all these layoffs in technology, 100,000 jobs cut in the tech sector this year, yet the NASDAQ 100 on the year up about 15%. A piece of this may have to do with previous cycles. You have these layoffs, and the bad news is seen as good news in terms of the worst is over. But we do have the possibility of some sort of recession, maybe a rolling recession, and if we start to see these layoffs continue to spread into other sectors, John, it could be a problem.
That's the big if. Abby, thank you for that. Thank you very much. That's the disconnect, for some of you at least. One industry, does it spread? And ultimately, when does it start to show up in the overall numbers? Jobless claims just starting to clip higher this week for the first time, I think, in about 6 weeks, but claims still sub 200K. This is the message from David Kelly at JP Morgan. The resilient growth story won't last long. He writes the following: despite recent strong numbers on GDP and jobs, there is a slowdown lurking which should belatedly cause the Fed to reverse course. It could benefit investors who are willing to position themselves today for an eventful return to a slow growth, low inflation and low interest rate economy. David, I'm pleased to say, joined us right now. David, great to catch up, sir, as always. So let's start there. There's a growth slowdown lurking. Not many of us can see it. What do you see?
Well, I think both the GDP data and the employment data are very distorted right now. So first of all, on the GDP side, we saw a big run-up in inventories in the fourth quarter. I still think the trend growth rate of the economy right now is running probably less than 1% in the first half of this year. And the problem is that's going to keep going over at least the next 2 years. We've got, a very tight labor market, so we don't have any extra workers to throw at the economy. Productivity growth isn't that strong on a trend basis, so the economy is going to grow very slowly anyway, and the fourth quarter was something of an anomaly. And same thing with employment. I mean, remember, not seasonally adjusted, employment fell by 2.5 million people in January. Now, if you've got a very tight labor market, and this is the one time that you can actually hire somebody who just got laid off, or maybe you hire them. And equally, if you've had a really hard time finding people, maybe you don't lay them off. So I think the fact that January is always so weak in terms of employment kind of distorts these numbers. So I'm suspicious of that. What I see in the economy, though, is a lot of drag, which is going to keep this economy very slow and on the edge of recession if it doesn't fall into recession for the next 2 years.
David, this quote, slow growth, low inflation, low interest rate economy, is this 2019 again? Is that what you're looking for?
Yeah, I mean, we've been on this huge roller coaster, but the interesting thing about roller coasters is you actually get off where you got on. And I think that's exactly where we're going to end up. I think we're going to end up back in the middle of the last decade with the inflation rate going down below 2% in 2024. And in the middle of this decade, the Federal Reserve is going to be muttering about how they can get inflation back up to 2%. This economy is not an inflation-prone economy, and if we just wait for this thing to work its way through, I think we'll be back in a very slow growth, low inflation environment.
So, David, I know a ton of people who take the other side of this, who think we have serious regime change on our hands, which means serious leadership change in the equity market. Do you take the other side of that debate as well?
Well, I think that the change in leadership that we've seen in the last year is long overdue. I think that there was an exuberance about markets in a very low interest rate environment, which caused growth to outperform value. And now we've seen that gap close. I think we could see some more closing of that gap in volatile markets, but the gap's not as large as it was. So overall, within the U.S., I think things will be pretty close between value and growth between small and large. The one obvious discrepancy still is the dollar is way too high. And we saw the dollar fall, and now it's reversed a little bit on these strong economic numbers. But I think that long-term decline will resume over the next year or two. So I think that's one part of leadership we still have to see change here, because the U.S. is still, has beaten international equities for so many years. I think we do still need to see some reversal of the dollar, decline in the dollar in the long run, and international equities do better relative to U.S. equities.
David, can we get your world without a contraction in consumer spending, which has been supported for so long now?
Well, you can't get into a recession, I don't think, without a contraction in consumer spending. But remember, consumer spending is 2/3 of the story. But housing is obviously very weak. You've got net exports are going to be weak because of the high dollar and relatively slow overseas growth. And then government spending, certainly from the federal government, is going to be pretty constrained. So I think you can get a slow growth environment, but you're right. If consumers don't actually go negative, I think you avoid a recession. But there's not a lot powering consumer spending growth going forward. Remember, the saving rate is half what it was a year ago. So people have been racking up credit card debt, trying to maintain a standard of living, which they're not going to be able to maintain. And so I think consumer spending growth will be very slow from here, although it may not turn negative.
Sounds like you're pretty constructive on the bond market. Michael Hartnett at BofA put out a note this morning. He said 60-40, that portfolio, best start to any year since 1991. David, you might appreciate this quote. He said, an English strategist moved back to London with his wife from New York. After 3 years, someone asked the wife, what's the best thing about living in London? And the wife replied, Paris. That's his quote, not mine. I love London. Went on to say, what's the best thing about stocks in 2023? And he said bonds. Now, David, I just wonder how supportive you think bonds are going to be this year.
I think it should be a good year for both stocks and bonds. But if you're a long-term investor, I think you will get better returns out of the stock market longer term. So, I wouldn't. It is true that last year was a bad year for bonds after many good years for bonds. And I think that that we saw that 1 year reversal. I think bonds will do well today. I think people this year. I think by the end of the year, people will recognize that the Federal Reserve cannot sustain a federal funds rate above 5% for long. They're going to start pricing in cuts to that federal funds rate, and I think that'll help the bond market. But still, in terms, given where we're starting in rates, I think that over the next 5 years, you'll make more money in stocks.
David, I just want to finish with one more question on stocks, if I can, and that's on Europe. David, I heard you do a podcast recently with Meb Faber. I thought it was fantastic, and you talked about Europe, and you said the one thing that would change investor attitudes is performance. We're getting that performance, David Kelly. Why do you think it continues?
Global stock market investors. We are the world's stock market investors here in the United States, and we've got to feel better about Europe for European stocks to outperform, for global investors to put money into Europe. So I think part of it's about European stocks outperforming for a little while, but a lot of that is also about the dollar. If the dollar comes down, that's going to cause European stocks to outperform for US investors. If that continues for a year or two, then I think a lot of people are going to jump on the bandwagon. David, brilliant to hear from you. Something very self-fulfilling about all of that. David Kelly there of JP Morgan. David, thank you. Equities right now, about 16 minutes into the session, down 0.2%. One story we still haven't discussed this morning. Up next, a new candidate emerging for the BOJ.
Ueda-san is an academic. He's not political. He's very pragmatic. And he says what he sees.
That conversation up next.
Names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, went from 5,000 to 45,000, I would be wiped out on the short side. So it's just too volatile to short.
The complicity of the international finance institutions, including particularly Goldman Sachs, is there. Otherwise, one MDB wouldn't have happened. You can't just get away and by ignoring your moral responsibility And I think Goldman Sachs should come out clean and deal with Malaysia.
Ueda-san is an academic. He's not political. He's very pragmatic, and he says what he sees. When you look at the dollar-yen reaction this morning, that to me was a classic example of people pulling materials of comments made by Ueda-san over the years. There were hawkish comments, there were dovish comments, and I think there was reactions either way to that.
Love how, Paddy. Maybe a little bit of confirmation bias there, depending on which headlines you want to choose. Japan Eiger, surprise candidate for BOJ governor. Bloomberg reporting, alongside many others, the Prime Minister is set to nominate Kazuo Ueda to leave the central bank. The decision blindsiding investors, expecting the deputy governor to take the helm and sparking a bit of volatility in the Japanese yen. Mike McKee, what do we need to know about this gentleman?
Well, you have to start with the fact that Kuroda-san, Haruhiko Kuroda, is leaving the Bank of Japan after 10 years. March 20th, his last day. And he put in place yield curve control and a whole lot else to try to keep interest rates low and push inflation up. Now, as you say, he is leaving, and for a long time, his deputy, Masayoshi Amamiya, was expected to be the replacement, and he apparently turned the job down. So the reporting from Tokyo is that Ueda-san is going to take the position. He's a former Bank of Japan governor, a board member himself. And then the question is, what are his policies going to be, specifically around this one, yield curve control? The Japanese have been doing yield curve control for years now. Kuroda put it in place, and basically they will spend anything necessary to keep the yield on the 10-year note in a low range. You can see the yield curve in Japan is kinked because of that. And there's a feeling that now with inflation double what the bank's target is, they could get rid of it. And so everybody is asking, what is Ueda going to do? Now, he has suggested that perhaps they need to think about, in the future, changing it. Current policy is appropriate, and monetary easing needs to be continued at this point, he says, but he suggested a policy review at some point in the future. So there's your both sidesism, John, that you were talking about. As I mentioned, a university professor, BOJ board member. He has a PhD from MIT, very well connected to the BOJ. So he is not expected to rock the boat. And as Derek Halpenny said, he is considered something of a centrist without a very strong viewpoint on what should be done. We should also mention that Shinichi Uchida and Ryozo Himino were expected to be his deputies. Both of them have supported yield curve control and have worked closely with Ueda-san in the past. So they may have a unified group going in. They just have to decide what they're unified to do.
Let's see if this gets confirmed first. Before March 10th as well, Mike.
Yeah.
Because March 10th is the last Kuroda BOJ meeting.
The word is, at least it was yesterday, that the Prime Minister is going to submit the names next Tuesday, CPI day, because we don't have enough to do that day. And
assuming
we'll look for
he actually accepts this job, unlike the other individual. Mike McKee, thank you. Getting us up to speed on the BOJ. Important meeting March 10th. Let's see if we get that change from the BOJ on yield curve control. To Mike's point, equities right now, where are we? 23 minutes into the session, we are negative 0.2. On the Nasdaq, we're down about 0.6%. Your trading diary up next.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Almost 26 minutes into the session, no real drama. On the headline index, the S&P down about 0.2%. On the Nasdaq, down 0.6%. Heading towards still, though, a week of losses. That's the price action. Here's the trading diary. Coming up, UMich Consumer Sentiment Survey, top of the hour. President Biden speaks with Brazil's Lula at 3:30 Eastern. They'll have a meeting later. Plus, we'll hear from the Feds, Waller and Harker, throughout the afternoon. Looking ahead to next week, the only thing that matters, Tuesday morning, CPI on deck in the United States, and no doubt more Fed speak, including from Logan and Williams. From New York City, that does it for me. Enjoy the long weekend of the Super Bowl here stateside. Good luck for the rest of the trading day. This was the countdown to the Open. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines
has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in prize stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Wienergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wienergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. so the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this.
I made the options video where I was like, options are just like shopping.
Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price?
And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As well as describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, we say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We got a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools.
Wow,
So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
They're stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the Garden City feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planted terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next, and the model can be applied